Hi all, I'm and welcome to Vayalil Capital. So on the last video, I have explained you about SIP, and in continuation with that video, today I'm going to tell you about how we can make SIP more profitable. That is, first of all, I'm going to discuss or I'm going to explain you some article about SIP. First one, STP is moving from one mutual fund to another, and the second one, STP is better than the lump sum investment. The third one, STP happens between the funds of the same mutual fund company, and fourth one, keep an eye on the exit load of the debit fund. Fifth, that is, choose a destination fund according to your investment goals. And the sixth one is frequency and amount of transfers. And at last, the seventh one is how to start an SIP. Moving in detail with the first one, that is, STP is moving money from one mutual fund to another. That is, systematic transfer plan allows the investors to invest a lump sum amount in a mutual fund and regularly transfer a fixed amount into another mutual fund. It helps the investors by reducing risk exposure in volatile markets. This option is opted for one wants to invest a lump sum amount but wants to avoid the marketing time risk. That is, the most common and sensical way of doing the STP is to transfer the money from a debit account to an equity fund. You can learn and understand more about STP here. That is, what is STP in mutual fund? Example. Suppose an investor has rupees 10 lakh and wants to invest the money in a mutual fund. Now, in order to avoid the risk of timing the market, he wants to invest through SIP. Now, he has a large sum in the bank and wants to invest a fixed amount of 20,000 rupees monthly over a long period of, say, 50 months. In this scenario, a large sum of money sits idle in the bank account for a very long period of time. For instance, the funds for the last 5 installments amounting as rupees 1 lakh shall remain idle in the bank account of the investor for almost 3 years. That is, in order to avoid this situation, an investor can opt for the systematic transfer plan option. This way, the entire sum of rupees 10 lakh can be invested in a debit fund to earn, that is, around 7 to 9% instead of 2 to 4% normally earned as savings interest. From this lump sum investment in a debit fund, rupees 20,000 would be transferred monthly to an equity fund of the same AMC in the form of a systematic investment plan. And this ensures that the investor's money is not idle in the bank, and simultaneously he is able to take the benefit of rupee cost averaging, which rises from the investing to equities through the SIP. Now moving on to the second one, that is, STP is better than the lump sum investment. The investor should usually opt for the investment through SIP. However, the surplus or the excess fund may be invested through the SIP option. In any case, the investment through the lump sum is not a good idea. It exposes the investor to the risk of market timing. The investors could be purchased at a time when the markets are high, which means that if the market goes down, you could end up suffering short-term loss. The factors favoring the STP as a better investment option over the lump sum. That is, the first one is market risk. Investment in lump sum may lead to an investor investing his entire at the high prices in the market. That is, this may lead to low returns and even losses in some cases. Investing through the SIP or the STP reduces the risk and provides to its investors the benefits of rupee cost averaging. The second one is returns. Since investment through the STP yield returns from both the debit funds as well as from the equity mutual funds, the returns are diversified and is higher when compared to investing via SIP while keeping the money in a savings bank account. The next one is flexibility. The STP can be made faster or slower upon the discretion of the investor. Therefore, it can be adjusted and altered to match the valuation in the market, and also that is according to the prices in the market being undervalued, overvalued or accurately priced. The rupee cost averaging. Investment through STP allows an investor to purchase equity funds at different ways. That is, this enables an averaging out market highs and lows and therefore the risk of buying dear and getting the stuck. The third one is the STP happens between the funds of the same mutual fund company. That is, the investor must keep in mind that an STP always takes place between the funds of the same fund house. It is not possible to have an STP between the funds of two or more different mutual funds companies. That is, an investor who decides to exercise the STP option need to decide the debit fund and the equity fund of the same AMC or the asset management company. For example, if an investor wants to transfer the money into an equity fund of, say, that is Reliance Small Cap Fund or Reliance Top 200 Fund, that is, he must first invest the lump sum money into a debit fund of Reliance Mutual Fund, such as the Reliance Money Manager Fund. In a way, the choice of the desired equity fund shall determine or to have a role in the choice of the debit fund. Firstly, the amounts need to be invested in a debit fund of the particular AMC and then transferred to the desired equity fund or to that same mutual fund house. The fourth one is keep an eye on the exit load of the debit fund. An investor must carefully select the debit fund where there is no exit load. Exit load is a free charge when you redeem your investment from a mutual fund before a certain period of time. The exit load is calculated as a percentage of the amount being redeemed. For example, let's say the amount being redeemed is 20,000 rupees per month. And the exit load is charged at 1%. So the exit load payable by you is total exit load equals, that is, the rate of the exit load into the redeemed amount, or the total exit load equals 0.01 into 20,000, that is equal to rupees 200. An investor must keep in mind that the exit load shall be changed periodically each time the transfer takes place, and this is because the STP transfers the fund from the debit fund to the selected equity fund on a regular or a periodical basis. And also, as regular and frequent redemptions are made from the debit fund, an exit load for the debit fund may severely impact the returns of the investor. On the contrary, unless an investor is withdrawing the funds regularly, equity funds exit load will have a comparatively lesser impact on the overall cost and thereby returns of the investor. So, the exit load of the equity fund you are investing in does not have much significance. The fifth one is choose destination fund according to your investment goals. As mentioned earlier, the investment in the choice of the debit fund is guided by the choice of the equity fund. Equity mutual fund should be selected on the basis of the investment objective of the investor. The risk appetite and the return exception will have a major influences in designing the time of the equity mutual fund most suitable to meet the investor's investment objective. Equity mutual funds are of various kinds, that is, each suited to have a different purpose. Therefore, the investors must exercise the utmost care and planning while selecting the desired equity mutual fund for transferring the investment from a debit card. Large cap funds have lower growth potential and give the investors lower returns on investment as compared to the mid and small cap fund. But they provide good stability in returns or investment if invested for a longer duration. Investment in a large cap fund is best suited for investors with low risk appetite and for an investment of lump sum amount. The mid cap fund have better growth potential and give the investors the higher return on investment as compared to the large cap funds. Investment in the mid cap companies is best suited for the investment with a moderate risk appetite and is most popular among the investors. And also, the small cap funds have exponential growth potential and give the investors high returns on investment. The investors in small cap is best suited for the investors with a high risk appetite and have good knowledge of the stock market. Similarly, investors may also choose to invest in other popular type of equity mutual funds such as the balance funds, equity linked savings scheme, and also among others. The balance funds are the funds that invest some proportion of their total corpus in equities and the remaining in the debit securities. They provide a diversified portfolio of the debit and also the equity and thus helps in minimizing the risk exposure to the investor. The sixth one is frequency and amount of transfers. That is, it is above the discretion of the investors to decide on the frequency and the amount of transfers from debit fund to equity mutual funds. The frequency depends upon the investment horizons of the investor. If you transfer money too rapidly from a debit fund to an equity fund, you do not get the benefits of rupees cost average. That is, since all your money will get invested in a relatively short period of time, chances and the market's condition will remain largely similar. Thus, you run the risk of investing at a time when it might be very high. On the other hand, you could also end up keeping the frequency too low. In that case, your money could be lying in a debit fund earning lower returns for too long. That is why it is very necessary to choose the right frequency for transferring the money from a debit fund to an equity fund. And at last, it is how to start STP. Deciding the target equity fund and also the debit fund, transferring between the two on a regular basis may seem to be a complex and complicated process in the first instance. However, the entire process of investing through the STP is very simple and easy to execute. An investor needs to follow these steps, that is, get your investment account activated, complete your onboarding or inboarding and upload necessary documents. Get your investment account activated, complete your onboarding and inboarding and upload necessary documents. Select equity fund or equity funds portfolio in which you want to invest for long term. Select and invest in debit fund or debit fund portfolio in which you will invest a lump sum. Make sure these are from the same fund house. Call or email Grow support at 910-880-0604 or support@grow.in, that is support@grow.in with the details of the equity fund portfolio. STP is a great way to manage a large fund. STP is a great way to manage the large funds available for the investment. It enables the use of the systematic invest plan to achieve the benefit of rupee cost averaging while making the use of excess funds by investing in the debit mutual fund, which debit funds give reasonable returns and also the fixed deposit and the savings return. Equity gives higher returns while diversifying the risk of the investor. Now let's move on to the Kinza Wellness projects, that is, Kinza established in the Middle East in 1957 and their business portfolio covers the F&B, hospitality, garments, marine services, constructions, resort development, organic farming, event and entertainment. In 1985, by starting the Shifa Clinic in Thrissur, the Kerala Kinza stepped into the wellness and the healthcare industry. Dr. Shihab Shah, a passionate health expert. Dr. Shah holds a MD in sports medicine and nutrition and a PhD in alternative medicine and wellness. Under him, the growth is working towards its mission of owning and managing 100 wellness hospital, 1,000 wellness clinic and well-being centers across the globe by the year 2020 with a vision to provide the people with high equality wellness treatment, products and also to become a leader in medical and wellness industry. With the India's #1 wellness hospital is emerging, the group has already stepped into manufacturing of the wellness products such as the food supplements, cosmetics, hygiene, pharmaceutic and also the nutraceutics products in 2020. I would like to share with that our subscribers, that is within 21 days, our subscribers have increased to 500 plus subscribers, and it's my great pleasure to thank each and every one for your support and keep supporting us. Please, if you people have watched our video for the first time, please subscribe and also hit that bell button and share with your friends and family. Once you have taken your time, you will want to take any profit according to the stock marketing, you can comment below and our experts will be commenting for your reply. And if you people have any doubt regarding my explanation over here, you can easily comment in our comment box.